Good morning, friends. Now, I would like to invite you for lecture series 7 of Unit 6 Mutual Funds. The discussion point con- contains concept of factoring, meaning of factoring, process of factoring, and types of factoring, and advantages and disadvantages of factoring. Friends, we have already seen the services provided by financial institutions, that is after understanding the banking and its functions. The next part that we started discussing is relating to the financial services that are being provided by non-banking financial institutions and financial institutions and even banks. Now, mutual fund is one of the financial services provided by the financial institutions, uh, that is non-banking financial institutions, to the public, to the client. And after studying that, we have already seen the depository system, how the depository system service is provided to the investors in keeping the shares or debentures or bonds in electronic form in a demat account. And after studying that, the next fact information, that next service, financial service, that are being provided by these financial institutions are factoring services and securitization services. What is this factoring services and how financial institutions are providing this factoring services? The factoring services concept basically comes because most of the businesses which are being done in the market are all not on cash basis. Credit is the most integral part of every business. So you may be knowing, when the buyers and sellers are selling the goods and transacting the goods, many a time the sellers issues the goods, sells the goods to the buyer on credit basis. On credit basis. The buyer may not pay the price of the goods on the spot when he buys the goods, but he expects that credit has to be given to him, because when the price of the goods is high, or when the trading transaction is big one, where the buyer may not be able to pay out on the spot, or in such a certain cases where the future contracts are undertaken in the sell buyer, between the buyer and seller, where the buyer seller promises to sell the goods, a full unit of goods in future, where buyer places an order for the goods, where the goods will be sold or transferred to the buyer in future date. For example, if you place an order for the production of machineries, equipments, it will take for for the purchase of, say, for example, ship, for example, that is not available readily with the seller of the ship. He will start manufacturing at against the order of the buyer and prepares all that, and finally after maybe around 3 4 months afterwards, the ship may be transferred to the buyer. In such cases, the deal happens in a credit basis, on the credit basis, where the buyer pays some portion of the price of the ship in advance, and able to receive the remaining finance, be able to pay the remaining finance full price after the delivery of the ship. In such cases, the credit transaction comes into existence. When the credit transaction is being impacted, the seller needs the guarantee that the buyer is going to pay the price of the product in future. Therefore, in order to undertake that kind of contracts, the seller is expecting the buyer to pay, issue the bill of exchange. We have already seen, you have already studied the bill of exchange concept in first year itself, in first semester, in financial management as well as financial accounting. In financial accounting, the bill of exchanges, how they are dealt in the accounting transactions, bills receivables and bills payables, that you might have already studied. The bill of exchange is a unconditional order signed by the maker, that is by the buyer, promising to pay the price of the goods in future date, price of the goods in future date, and it is issued to the seller. It is issued to the seller. For a seller, this bond which is written and given is becomes a bills receivable, and for the buyer, it is a bills payable. Understand? Buyer, it is a bills payable. When the bills receivable is received by the seller, it is nothing but his sales proceeds are locked in the form of bills receivables, and which he may not use that funds in his business. Suppose if there is any urgency arises with the buyer, with the seller regarding the finance, then the bills receivable which is he has received from the buyers is discounted with the banks, with discounted with the financial institutions. This discounting of bill is nothing but factoring. This discounting of bill is nothing but factoring. So the financial institution is called as a factor. Financial institution is called a factor, and the bills receivable submission, that is the seller who submits the bills receivable, is considered as a client, and the person who is supposed to pay the price of the bill after a few days, after few days, is considered as a customer. So these three parties are involved in this factoring activity. We will understand in detail the meaning, the different types of factorings, advantages and disadvantages of factoring. The basic definition. Now we have understood the basic concepts, how factoring services emerge in business because of the bills receivables, or what we call as invoices. We call that bills receivable with another term called invoices, because invoice is the list of the goods that are being transferred by the seller to the buyer on a credit basis, and against the list of that particular goods he has received the bills receivables from the buyer who bought the goods on credit basis, on a credit basis, and invoice is considered as a bill of exchange. Factoring involves a financial arrangement between the factor and the client. Here client means the seller who has sold the goods on credit basis. Normally the factor is having, normally the client is having an account or trade relation with the factor. So the factor has a, knowledge of the customer, that is a KYC information about the client, because he has already dealt with the financial institution. That is why he is called as a client. In which the firm, the normally the client is a seller. Seller is normally a registered firm. The company gets advances in return for receivables, that the seller gets the advance on the receivables from the financial institution, that is called factoring, from the financial institution called a factor. It is a financing technique in which there is an outright selling of a trade debts by a firm to a third party, that is factor, at a discounted price. In this case, the seller who is having a bills receivable in his hand gets encashed with a third party called a financial institution, that is a factor, on a discount basis. In this case, the financial institution who is acting as a factoring agent or a factor will receive that bills advances and pays the money in advance before the maturity of that particular bills. Once the bill is matured, once the bill is matured, that matured money will be collected from the client, from the sorry, the customer, that is the bills issuing purchaser, buyer who has bought the goods on credit basis. Normally bill of exchange is a shortened financial arrangement which ranges from 3 months to 1 year, not more than 1 year. So before the maturity of the time, the factor receives the bills receivable from the seller, pays the money to him at a discounted price, and charges the certain factoring charges to the seller. But seller, even if there is a charge or discounting, will receive the cash because he needs that funds so urgently in his business that he may not wait till the maturity of the bill happens and the payment received from the to be received from the buyer of the goods on credit. So the rights of collection of that particular bills receivable is transferred from the seller to the factoring company, that is a financial institution. Financial institution, after the maturity of the time, it collects the funds of that particular bills receivable from the client, from the customer, and satisfy the transaction. So this is how the factoring works. If you see the factoring procedure, whatever I have discussed is put in the form of a diagram, that there are three parties involved in the factoring transaction. One is called as a factor, is a financial institution. Another one is called a client or the sales organization selling the goods on credit basis. Another one is the customer or the buyer who buys the goods on credit basis. Now here what happens, the client or the seller sells the goods on credit basis to the customer. So against the credit base pay sale, the customer issues the invoices to the client. Customer issues the invoices to the client. When the client gets the emergency of the funds, these invoices called bills receivables are submitted a copy of the invoice to the factor, and factor is going to pay 80% or 80 to 90% of the value of that bills receivable to the client. Suppose, for example, if the bills receivable is the bills receivable issued by the client from the customer of the sale value of 10 lakhs rupees, 10 lakhs rupees, the bills receivable of 10 lakhs rupees will be submitted to the factor for liquidating the bills receivable before its maturity. In this case, the factor will pay the money to the client to the tune of 80%, that is up to 80,000 rupees, or 90,000 rupees will be paid to him, to the client, and 10,000 rupees is kept with him, and he will levy the charges of interest or service charges to the client. Once the bill gets matured, once the bill gets matured, so that will be, factor will be receiving that money from the customer, that is from the customer, that is a payment of account from the customer. And that when he receives the payment of the account, balance amount of 20% will be paid to the client. And here the factor is charging the factor service charges to the client, to the client. So this is what we call as factoring procedure. Now, origin of factoring, if you see, the factoring came into existence in 1920, but it was not an organized sector at that time. In 1920, factoring was done by the unorganized sector, individual sellers with their own confidence and all that. But the Association of British Factors came in 1976 in India, and nearly 90% of the global factoring turnover comes from USA and Europe countries. Now, RBI appointed the CS Kalyan Sundaram Committee in 1988. It suggested to start the factoring by a bank through its subsidiary. So then the factoring business came into organized sector. Now the factoring services are provided by the financial organizations, financial institutions as exclusively registered factoring firms supporting the business transactions for liquidating the bills, invoices before its maturity, which will help the sellers who have sold the goods on credit basis, where they are not able to wait till the credit amount is received from their customers. So that is why factoring is gaining a momentum and most importance in the country. Now, if you consider the various types of factoring, the factoring can be classified into four different categories or types. One is called as domestic factoring. If the all the customer client factors are within the country and the transaction happens within the country of India, it is called as domestic factoring. For example, the Tata company, which has sold certain goods to particularly its clients. For example, if the Tata supplies the goods to Big Bazaar, Big Bazaar on credit basis at around worth of rupees 1 crore rupees on credit basis, where the credit payment term is for 6 months. And when the Tata is in need of any financial arrangement, he will be approaching certain factoring company like ICICI Bank for the early payment maturity of that. So ICICI Bank will issue around 80 lakhs rupees to the Tata company and receives that invoices after the maturity of that particular credit period. The ICICI Bank will receive the uh, bills payable amount from the Big Bazaar Group, and then the remaining 20% lakhs rupees will be paid to the Tata company, for which the banker may charge around 2 to 3 lakhs rupees, maybe around 10% or maybe around 5% or 2.5% interest on the advances paid to Tata. So like that, all the three parties are benefited here, and all the three parties are connected to Indian company. That is called domestic factoring. International export factoring refers to when two different country buyers and sellers emerge into transaction and factoring services is provided, is called as international export factoring. For example, the Indian company, an example is, for example, your the Patanjali Ayurvedic Company Limited exports a honey to USA company, maybe called as a USA Nestle company. For example, it supplies the honey on credit basis. The transaction worth is around 5 crores rupees. Honey has been sold to foreign USA company. It is called as exporting. When exporting is done, the buyer of the USA company is not able to pay all the money for around 10 crores rupees cash on the time. So it will ask for around 1 year credit sale, credit purchase. In that case, if the uh, credit bills receivable or invoices received by Patanjali are encashed before the maturity of 1 year with the State Bank of Factoring Agency of State Bank of India, and if it is encashed and the amount is paid by the State Bank of India to the Patanjali, and after that, if it receives the money from Nestle company of USA and settle the transaction, it is called as a cross-border transaction or international export transaction. So this is called as international factoring or international export factoring. Now we have one more type called recourse factoring and non-recourse factoring. Recourse factoring refers to where the factoring organization, what called as financial institution, does not take the risk of dishonor of the bill if the client or the if the customer of the customer who is supposed to pay the bills receivable money, if he fails, if he does not pay on time, and if the bill time is over, it is called as dishonor. If the bill gets dishonored, the factoring organization ex- charges all that amount to the client and receives that all amount from the client and use back the bills receivable rights to the what you call as a client, is called as recourse factoring. In a recourse factoring arrangement, the factor has a resource to recourse to the client, that is selling firm, if the receivables purchased turn into bad debt. That is, risk of the bad debts is to be borne by the client, and the factor does not assume the risks of the default associated with the receivables. The difference between, and that is what here the total risk of dishonor of the bill or non-payment of the money by the customer lies with the client. So whenever such kind of dishonor happens, the full price of that money which the client has received, or the issuer of the seller has submitted that bills of exchange to the factoring, will be purchased, where the it will be transferred to the client, and the client is to pay the whole money to the factoring agency. So factor is not taking any risk of dishonor or bad debts in this case. But in case of non-recourse, the rights of collection of the money is given to the factor in the transaction, where if the bill gets dishonored, the collection charges and all kinds of what you call as legal rights will be taken implemented by the factoring organization on the business that customer who has purchased the goods on credit basis. So the court charges, all that recovery charges are made by the factor, and factor will settle that particular transactions of invoices is called as non-recourse what we call as factoring. Non-recourse factoring. Non-recourse, recourse refers to the liability or the risk. It is, if it is with the client only, if the dishonor happens, it is called recourse factoring. Non-recourse in the sense all that rights or bad debts suffered by the factoring organization or financial organization entered as a factor, he will suffer that. So rights of collection and everything will be taken to the from the client when the factoring contract enters into takes place. So this is how the recourse and non-recourse bills, that is factoring. Then we have one more called okay. So these are the four different types of what you call as factoring agreements. In examination, there will be a question called write short notes on recourse and non-recourse factoring. Then you have to write these two. What is the basic difference between recourse factoring and non-recourse factoring? This will also be asked in the examination for 3 marks. In case of recourse factoring, the client is required to buy back the unpaid bills receivables from the factor, that we have already seen. Second one is in case of on the other hand, in case of non-recourse factoring, here the factor shall bear obligation of that is absorbing those bills receivables which remain unpaid. So the client will be having the responsibility in a non-recourse bill that in case of non-recourse bill, the client is not having any obligations of absorbing the bills receivables which remain unpaid, where the factor or the financial organization itself will take an action on the customer and recovers the bills. That is called non-recourse factoring. And on the second ground, the credit risk stays with the client in case of non payment, in case of recourse factoring, whereas the business resources remain unaffected, the client's business affected unaffected, where the factoring company will use its legal obligations directly on the unpaid customer, and it recovers the money from them. So in case of recourse factoring, the financial institution will charge the less amount of discount or charges, whereas non-recourse, where the risk is totally taken by the financial institution, where he charges little bit higher amount of charges, factoring charges. This is known. What are the advantages of factor? How factoring will be more useful? In case of factoring, there are a lot of advantages to the client or the uh, seller, who can recover the money before the expiry. That liquidity is more with the factoring activity. The first important advantage is it ensures a definite pattern of cash flows from the credit sales. On the credit sales, definite amount of cash flows will be received. Second one is it serves as a source of short-term finance. So it is more opportunity for the factoring organization, financial organization, to provide the short-term financial services to the sellers who have sold the goods on credit basis. And third one is it ensures a better management of receivables as factor firm is a specified agency for the same. Now, in case of receivables, the recovery and all that will be undertaken by the factoring organization. So it is a more specialized agency which will help the sales persons who sold the goods on credit basis to get relieved from the recovery of that particular funds, because in case of non-recourse uh, kind of a bills, so seller is more relieved from the tension of collecting the credit money from the client, because the factoring agency, what you call is factor financial institution, will take the responsibility. Next, fourth one is it enables the selling firms to transfer the risk of non-payment, defaults, bad debts to the factoring firm in case of non-recourse factoring. That is one more advantages. Fifth one is it receives the selling firms from the burden of credit management and enables them to concentrate on their important business activity. So the risk of bad debts will be reduced. Next one is it saves in cost as well as space, that is space, as it is a substitute for in-house collection departments. So that is one more best way, because factoring organization will be having a what is claim settlement department, or what we call as a recovery uh, wing in the factoring organization. So that recovery wing is already having a legal cell and all kinds of things. They serve the notice to the client who does not pay the bills payables on time, and levies the charges through the court and all that. It is easiest way because the legal wing is maintained by the factoring company. Whereas in case of seller who sold the goods on credit basis, if he runs behind the recovery of that dishonored bill, it will be more costly for him. That is one more advantage in factoring. It provides better opportunities. Next one, G. It provides better opportunities for working capital management of the credit sellers. Working capital management will not be affected due to this kind of options. Only thing is that the seller has to incur certain expenditure for liquidating that uh, uh, bills receivable before its maturity. For that, he has to pay certain kinds of charges. The selling firm is also benefited by advisory services rendered by the factor. So when the bills receivables are to be prepared and all that, the legal services are also provided by the factor to the sales credit seller, how to prepare the bill of exchange, what are the legal documents, what should be the contents in that, everything will be guided to the particular person by the factoring agency. So these are the advantages. The basic disadvantages is the high cost of factoring as compared to other sources of short-term finance. In case if the seller has to encash that particular bills receivable before the maturity, the charges levied for factoring will be bit higher as compared to any other sources of finance. So sometimes the seller may feel that getting the bank loan is more cheaper as compared to factoring the bills receivables also. But bills receivable is a more easiest and convenient way of liquidating the asset, that is the bills receivables. That is why he may choose it. But there is a huge cost involved behind, because factoring factor will charge certain sum of money to the seller. The perception, second one is the perception of financial weakness about the firm availing factoring services, and the perception of financial weakness when the bills receivables are encashed by the seller with the factor. It gives a signal in the market that the seller's financial position is not so strong. When he has given the goods on credit basis, the waiting ability is less when he is going to encash that before the maturity. That signal will be passed in the market, and the what you call as worthiness of the organization, selling organization on credit may be affected. It is just a rumor. But sometimes when the seller, that is who sold the goods on the credit basis, finds a business opportunity where the return is higher than the bills discounting amount, then logically the salesperson seller will find it good to encash that credit, these things, and give a good business to factoring organization. So that is also there. The last one is adverse impact of tough stance, though stance taken by the factor against the defaulting buyer upon the borrower, resulting into reduced future sales. Sometimes when the factoring organization takes up a tough task to recover the funds from the customer may feel bad, and the relation between the customer and the salesperson, that is selling seller, may get affected due to factoring business. That is also possible. But when the credit is not paid by the customer on time to the credit seller, so then it is the default, of course. But due to certain kinds of trade barriers, if he is extending the time for one more month and all that, the factoring organization, which is having the right to claim the outstanding money, that is the bills receivables amount from the client, from the customer, will not give the chance for all that, and it may damage the business of the customer. So this leads to a problem in the market. These are the disadvantages. Now we will end the discussion on factoring here. I think all of you have understood the concept of factoring. In examination, question will be asked, what is factoring? Discuss the various types of factoring, or discuss the procedure of factoring. Kindly pay attention in preparing the for the exams. Thank you.